Welcome to the Service to Syndication Podcast, where we interview the biggest and most successful real estate entrepreneurs, investors, capital raisers in the world who have worn the uniform of this great country, those who provide services to our men and women in uniform, and other service-oriented professionals to provide you with the tool sets, the mindsets, and the skill sets to help you conquer your dreams and goals in real estate and to use this wealth creation vehicle so you can live a more successful, happy, and fulfilled life of generosity and prosperity. If what you desire is time, lifestyle, and financial freedom, you've come to the right place. We will bring to you the best real estate entrepreneurs who will give you the insights, the knowledge, experience, skills, so you can go out and crush it in whatever real estate asset class you desire. So grab a pencil and paper, sit back, and enjoy the ride on the Service to Syndication Podcast. Hello, my servicemen and women and other service providers. Welcome to another episode of the Service to Syndication Real Estate Podcast. I am your host, Cedric Marlowe. Here on the Service to Syndication Real Estate Podcast, we interview the most successful real estate entrepreneurs, investors, and capital raisers in the world, where most have donned the uniforms of our great country. We aim to provide the tool sets, the mindsets, and skill sets for you to achieve your personal and business goals while using real estate as a wealth creation vehicle to help you live a more successful, happy, and fun-filled life. I am super excited today because I have with me Mr. Scott Kidd, who is a fund manager and multifamily syndicator. But before I properly introduce our exciting guest to you, I want to ask a favor of you. Please, if you get some value out of this interview, if you get some type of insight, mindset shift, if you learn a new skill, receive new information, receive inspiration or motivation to go out and take some progress in your life, please share this with some of your friends. Send it to someone you know who might be or could be interested in real estate. Share it on your social media, post it on your wall, or share it in your stories. Help us spread our message while you help others. And for all of you who share this episode, I want to say thank you. Again, everyone, I have with me Mr. Scott Kidd. He is a proud University of Texas graduate and have spent the last 20 plus years navigating the world as a professional yacht captain. Scott's career has taken him across the globe, giving him firsthand experience in yacht management, luxury charters, complex refits, and overseeing new build projects. Those decades at sea taught Scott the importance of precision, leadership, and long-term planning skills he now brings to every venture on land. Today, he's a commercial real estate syndicator with a specialized focus on helping yacht professionals, private equity partners, family offices, and fund managers build wealth through passive income strategies. Scott bridges the luxury lifestyle of yachting with the financial security of real estate investing, offering tailored opportunities in multifamily assets and recession-resilient markets. Whether he's at the helm of a super yacht or structuring high-performing investment deals, Scott's mission remains the same: to create sustainable, generational wealth for those who understand the value of time, freedom, and smart financial planning. Scott, first off, welcome, sir.
Oh, thank you so much for having me. I really appreciate you taking the time to have me on. Thank you.
Yes. So, Scott, before you became this very successful person I see in front of me, in about 2 to 3 minutes, give our listeners a little bit of your backstory, like where you grew up, how was your upbringing, and what in your past shifted your mindset into becoming the person you are today.
Thank you again. I'm originally from Jamaica. My dad's Jamaican, my mom's American, and I lived in Jamaica the first early formative years, and then moved to Texas in the late 70s. And my parents, they always worked for themselves in heavy equipment, trucking, and stuff like that. So I was always kind of had it in the back of my mind that I got to work for myself. And eventually becoming a yacht captain, you're kind of on your own. You kind of run and manage and manage the vessel. And I've taken a lot of those skills, and which are quite a lot that you use in managing a vessel. Same ones you use, in business, especially in real estate, in syndications, funds, because you're doing a lot of things like negotiating prices with contractors. You're doing a lot of logistics where you're moving the boat around, you're managing people, and the managing of the people and working with people is probably the most important part. And that's the part that I found that I love the most about any business, especially in real estate.
Okay, so help me out here. All right. As I mentioned in your bio, you graduated from University of Texas.
Yes.
Now you're yacht captain. How did they merge? Where did that come
Well,
about?
well, funny. That's a funny story. Is actually I was in Austin, Texas, where University of Texas is, and I got into the tech field, which was nothing having to do with what my degree was or anything, but tech was doing really well there, and I had an IT business and a and I had a tech job. And one year, the same thing happened. I was laid off and lost the business in the same year. So it was a pretty rough year, and I was back in Jamaica, where I was there for a little while, and I was doing some things there. And after the business had gone bad, and my partner and I, we had some, decent financial burdens from that business. And then being laid off, I wasn't working, and I've started to do some things down in Jamaica that wasn't really working out very well. And a friend of uh, a friend of mine, he was actually in the Navy, which I know you were in the Navy as well,
Yes.
with another guy that he called me and he said, "Hey, do you want to work on a boat for the Fort Lauderdale boat show?" And this is around the year 2000. And I said, "Well, sure," because I'm things aren't really working out too well here. But I don't, I don't know anything about working on a boat. I mean, I've done some sailing and stuff, but I don't know anything about it. And he said, "That's fine, just get here." So I borrowed the money for the ticket. My friend that owned the bar there, that he had a bar business there. He gave me some cash in my pocket, and I landed in Fort Lauderdale with about $20, and I borrowed the plane ticket, and I didn't even know this could be a career, but I never looked back. I'd intended to go back to Jamaica and start something there, but that was all she wrote there. That's 25 years ago now.
Wow. Wow. Man, that's an amazing story. You just, you get a friend ask you, do you want to go do something
Yeah,
for a boat
yeah,
show,
yeah,
and off
yeah.
you go.
Yeah, I never, that was kind of how I lived my life, by kind of by the just whatever was happening at that time. And I was negative tens of thousands of dollars myself and my partner and everything else. And it didn't really, the thing is, what I thought was a very tumultuous year, which it was. We
Hmm.
lost everything and then some, but that all needed to happen for me to get to that point. So there's a lot of times things happen for a reason. If I
Yep.
didn't go through that, I wouldn't have become a yacht captain. I wouldn't have met my wife, wouldn't have had two beautiful kids, wouldn't
Hmm.
have gotten into real estate. Then my life would have probably been a totally different. I'd be a totally different person doing totally different things. Which both of these things, real estate and yachts, make me very happy. I'm very passionate about it. And I love sharing these experiences with other people because a lot of people like myself didn't know that they could have a career on yachts. They didn't know that they could have a career in real estate. They didn't know that these options are and opportunities are available to them because a lot of times, we're taught that we can't do things, but in America, you can do if you want to do it, you can do it.
That is very, very true. If you want to do it, there's nothing holding you back but
No,
yourself.
yeah,
That's it. So,
agreed,
yeah.
agreed, agreed, 100%.
Yeah. So, Scott, as I mentioned in your bio, you spent 2 decades as a professional yacht captain. Now, what lessons from managing vessels, crews, and long-term voyages have kind of translated into your asset management and investing?
I'm glad you asked that because a lot of times people don't kind of think there's a disconnect there, but it's all really. related because it's a both are people businesses because
Mm,
the difference between the two is that on the boats we have to live with the people. So that's a totally different thing. But the thing that I learned the most is that they are people businesses and finding the right person for the right job is probably the most important thing that you can do in any business or in any crew or anything because if you when you get that person in that position, everything, the growth and everything else for the whole program or the whole business is exponential because you know that person is fulfilling that need and doing that well and they're passionate about that and that's something that you know a lot of people forget in business is they're more transactional rather than you know when relationship driven because when you are relationship driven you know it's a long-term game it's a long-term business it's a and that's you know I've been very good and fortunate to be able to build some great teams and I've applied those same things same principles to real estate getting the right people in the right positions and a lot of times since I'm, you know, a lot of times like with the current people that I'm working with now, some of the people have 30, 40 years experience. So I'm kind of the junior of one of these organizations.
mm,
So I know what's necessary to be a good team member. So, you know, I always focus on adding value. You know, what problems can I solve for the team?
mhm.
What solutions can I provide? What what can I do to benefit us? You know, what can I take off somebody's plate to make it to where it's easier to where obviously they're doing double or triple duties. Let me take a couple of those things where they can do what they're good at and you know whether it's finding deals or analyzing deals or you know admin or what have you.
Yeah. I mean, a lot of things that, and I don't know if people really correlate things that they do on a daily basis or former job
Hmm.
into what they're doing in real estate, but a lot of
Yeah.
times, a certain skill sets or lessons learned can just correlate right over into what you're doing as an investor, you know?
Yeah, there's so many. I mean, like if you're, you know, some people might have a sales job and they might think, oh, well, I can't do real estate. Oh, yeah, you can. You could go wholesale. You could go be a realtor. You could actually raise capital. You could, you know, there's just so many. If you're good at sales, that's, you know, that's a really great skill that transfers to any type of business.
Wholeheartedly true. So, yeah, in yachting, as you know, mistakes can be costly. How has that mindset shaped your approach to risk management in investing?
Well, just being conscious of the cost of everything. And, you know, a lot of times I try to focus on not as much on the expense side, which is very important, as like on the income side. Like, what can we do to add more income? Like with the vessel I'm on now, like what can I do to help bring in some more charters, to more revenue in, so that it offsets more of the things that, you know, are necessary for the program. You know, and that's something a lot of times people always try to cut costs a lot, and you can only cut so much. It's there's a floor there where things stop working, and you know, organizations get a little too thin. But you know, like in business, if you keep like say with multifamily, if you add carports or you add you know pet fees or you add you know change the late fees. You know, you add you know, cable packages or, you know, internet packages or, you know, just a lot of different things you can do to maybe add just a few dollars. And when it's a few dollars with a few hundred apartments, it's quite a lot over the year. And then that increases the net operating income quite a lot.
Yep. So, have you seen any parallels between planning a global voyage and structuring long-term real estate investment strategies?
Yes, there's a lot of similarities because you have to take all the little details really matter, and there's where you really need a great team to help you out with a lot of the details. Some people are very good at, you know, certain certain things like, you know, I don't get too involved in like what the chef is meal planning, but that person, if it's a 2 week voyage, that person needs to be structured to where they everybody gets well fed because that being in the Navy, if people don't get fed well, that's a problem.
Yeah, big time problem.
Oh, and you'll know about it right away, and with that, with syndication, if you have to say let the underwriter do their if they're good at it, let them do it. Of course, everyone's going to verify and check it, but
Mhm.
same thing with the with the chef there. If their budget and everything is a certain amount, and you check to make sure, okay, the meal plan's fine, okay, that's good. Same kind of thing. You check with the engineers and stuff as everything, all the equipment is we do all the tests and everything, test all the equipment, make sure everything's good. And you know, with people that are raising capital, you want to make sure they set targets and everything. You make sure and check in with each other, and make sure that they have the tools that they need to do the job. Like, do you need anything? That's a good question to ask any of your team members. Like, hey, if you notice them struggling, hey, what can I do to help?
Yep. Yep. Just a question just popped in my head. You were talking about the chef on the ship and everything like that. Now, are you in charge of hiring the chef and all the crew, or how does that work? I just general
Yeah,
question.
yes, I do. I get involved with that myself, and there's two captains, and
Yeah.
we kind of go back and forth. Generally, go to our networks first.
Okay.
We know people firsthand, or first or second degree of separation. We ask the rest of the crew, heads of department and stuff, and ask them. It's the same, like any business, you ask the people that are your inner network first because you want people that you can directly talk to. Hey, how is this person? How is John over there? Was he good with people? Does he have the skill set? No, he doesn't have the skill set, but he can learn it. And it's like, okay, well, you already got it from a credible person that you already respect. So then, okay, we'll try that person first.
Yep. That's it. You start with your network and work your way out from there. And
Yeah.
usually, like you said, one, two degrees of separation, you usually can find what it is you're looking for
Yeah.
wholeheartedly. Yeah. So, Scott, for my listeners who are new to investing, how do you define passive investing versus active investing, and who is best suited? Who is each best suited for?
Okay. Well, the active investing, is something where like, you know, I had single family rentals before, and that was very active. And this is just an example. If something broke, I had a property manager, but I still had to manage the property manager. There was stuff that when the turnover happened, a lot of times I was over there painting, or fixing drywall, or fixing the plumbing or what have you. It was very active, and we had an 8 unit at one point, and it was during COVID, and there was a lot of times where I was driving to the boat early in the morning. I would go down there and do a couple hours of work, and then go to the boat, and then come back after work. And there's times where we were dragging pipe out of and managing the guys cutting concrete, dragging bags of dirt out of the place and stuff, and that's considered active, where you're actively managing, helping manage the property, and managing the whole project. But and someone that's suited for that is someone that maybe wants to eventually do real estate full time, whether it's in one of those segments like property management, or they want to be an investor where they manage all the assets. And because it is, for the most part, real estate is not necessarily passive. Even if you are a limited partner, which in syndications, you have general partners that run the deal, that manage the deal, manage the asset, they manage the property, and then you have the limited partners, which basically put up the money, or that kind of thing, and they're basically passive. And those are really good for like professionals, people that are building their careers, yacht professionals, doctors, attorneys, say they're building their business. and they don't necessarily have time to go and check on the property and drive by and buy a property or underwrite a property. You know, it's really good for those types of people, teachers, things that people that can save and put money into these passive investments.
Yep, that's it. That you hit the nail right on the head. Now, why do you believe commercial real estate, particularly multifamily, has become such a powerful vehicle for long-term wealth creation?
Well, there's a few things with that with multifamily you have, there's right now there's not necessarily you know, enough places for people to live, so there's kind of a shortage of enough rental properties for people to live in. And people are, you know, the affordability is there and everything, but people have to live somewhere. And there are also like government, loan programs that support only this asset class, multifamily, not storage, not office, not industrial or anything like that. Just only primarily multifamily because the government wants to make sure that these enough of these are built so that people can live somewhere. And people understand that concept, and I think that going long term, we are all going to have to live somewhere. And you see the trend with the affordability crisis, like people can't necessarily afford to buy a home as much anymore, and so they're staying and renting longer in a lot of places in a lot of regions. That's not true in everywhere in every
Mhm.
region, but because real estate is local, national averages are national averages.
Yeah, that's true. Like the affordability crisis, it is a
Mhm.
huge thing. Prices of homes have escalated, in certain areas. Forget about California. I mean, California, you can't even afford a cardboard box out there in these
A
places,
dumpster.
you know. So, but it's like that everywhere, even here where I live, the prices of homes have shot way past what a median income household can afford. So,
Yeah.
yeah, multifamily is that way to go because, like you said, people have to live somewhere. And it was a good point you brought up, Scott, that I really hadn't really given too much thought about with all the years that I've been in real estate is that the multifamily, single family as well, but multifamily, the government will assist to help you stay
Yeah.
somewhere where,
Yeah.
of course, I'm in self-storage as well. We don't get those subsidies. We don't
No.
get that extra
Yeah.
income for the government to come in and say, "Hey, Cedric, rent this out to this person and that person. Don't worry about it. I got you."
Yeah. Yeah.
So yeah, multifamily is definitely that type
Yeah.
of long-term wealth creation vehicle, and
Yeah,
park your
and
money
there's
here and
also
ride.
the loan programs, like HUD and Fannie Mae and stuff like that support, you know, larger multifamily projects and stuff like that, especially, if it's going to bring in a certain amount of housing units for a certain segment of population.
True. Yeah. So a minute ago, I asked you what's the difference between active and passive investments. So, what's one of the biggest misconceptions that high income professionals have when they first look at a passive real estate investment?
One of the biggest misconceptions is that a lot of times they chase the returns. They compare a lot of the different returns and everything else, and that's fine because that's what they're looking for. And but the biggest misconception, they think that maybe that's the most important thing. They could, granted, returns are something you definitely need to look at, but I would say more than anything else, what you need to look at is the operator first
Mm,
or the fund manager, especially like even if you're looking into stocks and stuff like that, look at who the CEO is, look at what the company's doing, that kind of thing. With the operator, that's where the operations start and end. And if they're a poor operator or they're, don't necessarily have a great track record, I have 100 plus questions that I fill out and I kind of look at, but they're all kind of about 70% of them are about the operator and their track record. You want to know that that person is going to go to the mat for you because you are putting your faith in that person.
Right. Yeah. As they say, bet on the jockey, not the horse.
Yep.
Yeah. Yeah.
Mm.
So now, what role does a sponsor or operator play, and why is that arguably more important than the deal itself? I mean, you practically just answered that question just now, it's all about the operator, if like you said, if they're poor operators, there's no mistaking that, so
Yeah.
their operations are gonna suffer. No
Yeah.
doubt about it.
Yeah. And you want to look at that they have seasoned experience, that they've been through multiple up and down cycles and stuff like that. And, one important question that I know that I always ask is, what is your worst deal and how did you solve to that problem? And I think it's important because if you, then you'll see how they're going to react, because a lot of people like to talk about, how well they've done, how all these deals are doing, everything's great and all this other stuff. It's the same thing like the person that goes to the casino and tells you the next day, oh, I won 20,000. But then what they didn't tell you is that they first lost 100. They're still negative 80, but
That's true. And it's funny you even mentioned that. I had a conversation the other day with someone. They had won like $800 like off of a scratch off,
yeah, yeah.
and they're hyped about the $800, but like you're saying, what about that $2,000 you spent,
Yeah.
over the
But
past several weeks trying to get this one hit?
yeah, yeah.
Yeah.
Yeah. And
Uh,
it's a one-time thing. It's not like it's if you're, investing in apartments or whatever. I don't know of anyone that just does one deal,
yeah.
especially if it goes well. The same thing like once we, rented the one house and eventually sold it, I was like, huh, I can go do this again. I can go do, then I found out about multifamily and commercial real estate. It's like, okay, I can continue to do this regardless of what business I'm in or what happens. Because like the reason why I got into real estate in general was because the yacht business is notoriously unstable. It would work on a wealthy person's toy,
Hmm.
and it could be, it's zero from hero to zero all in the same day. You can be, people's lives change. They go through divorce, people die, people get sick. Um, they might just not be into it anymore. They might not use it anymore, or their business takes a dip and they can't afford it anymore, or they don't want to afford it anymore.
Yeah.
So that's why I always had some kind of side hustle or some type of other activity, and real estate was something that you could build and create some cash flow from without with if you do it right, you don't necessarily you're you know you're not necessarily hands off, but you don't have your hands into it every day.
Right. So I know you said you have like 100 questions that you ask before committing capital over to an investor. Can you just throw off just a few other quick questions that some other people, for my listeners, if they're considering going in as a passive investor, that they may want to ask a sponsor?
Sure. Main thing, track record. What is your track record? What were your last three deals?
Hmm.
Um, who's the team? Who are your partners? Have you been on other teams? Are you involved in other deals? Are you co-GPing with other sponsors? Are you involved in any other things? Do you have any defaults right now?
Right.
You definitely want to check their criminal and financial background if it's available. You want to make sure, that you have as much information about them as you possibly can. And if they're the genuine thing, they will freely give you all of it.
Yeah, that
They're
is
not
very,
trying to
very
hide
true.
anything, and they're being transparent. And also, one thing that I think is very, very important is how they communicate with you.
Mm,
Talk about like, you talk when you ask them a question or you send them an email or a text or a phone call, how long does it take for them to call you back? How long does it take for them to respond, and how do they respond? Are
yes.
they aggressive, or they like, hey, oh, sorry, I didn't get back to you. We were in the middle of a couple things, but here's what's going on. And because generally how they communicate to you in the beginning, that's how they will communicate with you to the end. And ask them also when things go bad, as you do have some issues because it's an apartment or a commercial property, what is your process of, how do you let, your investors know? And what do you let them know?
Right. Yeah. Yeah. That saying goes, how you do one thing is how you do everything.
Yeah, that's for sure.
Yeah.
That's so true.
Yeah. So now I know you've had plenty of first time investors. How do you educate them so that they feel confident versus being overwhelmed?
Generally, in the beginning and all throughout the process, I try to get to know them and kind of try to get my get aligned with their interests, because it's not about my interests. I don't want it to be transactional. I want it to be a long-term thing. I want them to be able to feel confident that they're putting the money and their hard-earned savings and stuff like that into something that they believe in. It's something that they want to do. If it's not aligned with them, like I had an investor one time where we're working on a deal and I asked one of the first questions I asked him, I said, well, is this your emergency funds or your liquid funds? Or is this an extra 50,000 or 100,000 that you have that you want to invest? We're like, well, this is what I have, this 100,000 now. And I was like, well, you have young kids. I would recommend you don't do this because it's locked up for 5 years. And like, well, but I can get it out. And I said, no, you're going to be locked up. They said it's going to turn over in 3 years. I said, yeah, but that may not happen. Plan on it being closed off for, 5 years minimum, because if not, and you do have an issue with your kids or what have you, or life happens, the money won't be sitting there and you won't have that there for you. So, and he kind of didn't really understand. He kind of was a little bit upset with me because he really wanted to go into the deal. And I said, well, I'll do whatever you want, but I don't recommend that this is for you, not at this time, but, maybe you could do less or something, or maybe we can find something else for you that that can help you a little more, and then later on he did call me back later and he's like, you were right. It was a couple months later he called me back and said, this happened and I needed to do something with my business and put the money back in. And I said, well, good. So now you hoping you understand now that I was just kind of trying to look out for your best interest of something that was in alignment with you, because that's important to me. Because if I lose somebody, it's fine if I take the risk with
Right.
my money.
Right.
I understand it. Some things I didn't understand because obviously made some mistakes here and there. But
Yeah.
you know, if it's my money, I've done the my risk assessment. It's okay with what I'm okay with. But if it's their money and it goes down, I'm gonna do whatever it takes to get them their money back before I get anything.
Yeah,
You know?
that's it. That's admirable because as you know, you and I both know, capital raising, it can be hard and very daunting. Most times is. And for you to say to someone, hey, we're not going to take this 50, because if this is your last, and I'm paraphrasing, if this is
Yeah,
your last 50 and God forbid life happens, you're not going to be able to get this out. This is locked up.
yeah,
This is locked in. And, you reasoned with him and, he listened. It sounds like he listened and didn't go in with the
yeah,
investment, even though he wanted to.
yeah,
And these are the things that we all have to do, life decisions, life choices, where you just don't want to have take someone's last. That's kind of like how we
yeah,
say it in the business.
yeah. And you don't really want to really, when you see it's not in their best interest. Is that really going to do anybody any good? Probably not. Man,
Right.
in the grand scheme of things, it's $100,000. It's a lot, and it's a lot for them. But on the whole scale of the deal, it's not a whole lot. There's other people that are, you know. are ready at that point to do that. So, and I think good things come, if you go in with the best intentions, things work out.
Absolutely. So, Scott, why might an investor choose a fund, say, over picking individual deals?
Well, a fund may have multiple assets in it, and sometimes they do. And like the fund that we're working on for all our development projects are, we'll have medical office, hotels, multifamily, single family homes, townhomes in there, and luxury condos. So there's a range of different assets in there, and so you have a little more because each deal has a little bit different of a risk tolerance and stuff like that. And then you could actually put some in each one. You could diversify a little bit in each asset could be in different parts of the country, so you have a little bit of diversification there too. Um, that would be one thing, whereas you're going in deal by deal, you have to make sure, that deal is going to be what you want to do at that time and that the operator is the one you want to invest with.
Yep. Yep. Now, how does diversification work inside of a fund, and why does that matter during market volatility?
It matters, and diversification, you have diversification per asset, and then
Hmm.
you have diversification per region, like when each ones are in a different region. Then you have
Right.
diversification because there may be different partners in each asset, in different in each one of the assets in the fund. So you have multiple layers of diversification in there. And each one is bought at a different time. So you also have different, because if this region is good now, 5 years from now, it may be even better. So you have that also in your favor.
Yeah. Yeah. Going back to the fund that you said you guys are right now standing up. You talked about all the various asset classes that you guys are gonna, participate in. I didn't hear self-storage. I was hoping to hear self-storage, but it didn't
Not
pop
not
out.
yet, not yet, but I have done some self-storage. I was working on a new development I was in North Carolina, and they were, I think, done multiple I think since then. Um it's a great asset class. It's
Yeah.
just right now we have so many projects that I don't know if taking on more is probably will detract potentially from what we're already doing. But I do like it. I've invested in self-storage. Well, actually, I've looked at a lot of deals, and I like the simplicity of it. And it's a very dynamic, market-driven place, especially if you have one near a college campus,
Yeah.
something like that, and you're not saturated with a lot of the REITs
Yeah.
that are coming in. I know that has played heavily into the storage business, especially in some areas where they've come in and just bought and built an enormous amount of storage facilities, and they're cash positive, so they can hold for, 20 years, whereas we're
Yeah.
not there yet.
Yeah, it's like a lot of the mom and pop operators, they're doing good and they're coasting along, and here comes a big REIT and they
Bury them.
build a 4 or 5 story facility indoor, and you can drive in and you
Yeah.
name it, elevators and the whole 9 yards, and they cannibalize the market because they can come in with dirt cheap entry rates anyway,
Hmm.
even though most people don't realize that
It
month
goes
number
up.
2 or 3, boom, they're gonna shoot the rate up on you. But heck, you're already in, and it's gonna take you too much to go and dig all that stuff back
Yeah,
out of
yeah.
that. And it's
Most
like,
people don't move it out. Most people don't move their storage unit.
not at all.
No.
Once it's in there, primarily, it's pretty much in there for a while.
That's
But
a that's a good thing for the storage business,
yeah,
personally. But, you know,
absolutely. Long
it
as you don't have that REIT coming in there just cannibalizing the market, it's all
yeah, and
good.
I think I was told it was 8 square feet per capita. If
Yeah,
you go over that amount,
that's it.
that's where the market starts to get softer and stuff like that. And I
Yeah,
remember that always sticking out. And I think the ones that I was helping out on, they did they did they had an exit partner. They had one of those. larger storage facilities that would come in and buy it at the end, provided it met their cap rate at their buy-in cap rate, which I think they always hit the
Wow.
target. So I
Wow.
think that was a great plan because I saw that
Yeah.
having an exit partner is paramount.
Yeah. That's a unique business model. Wow, I've never
Yeah.
heard of that one. Honestly, that's a new one on me, but I mean, it's very unique and
Yeah, it was all new. It was all ground up new construction where they were building it to spec kind of for in that, and then they'd already contacted these guys and they'd done a feasibility study of those areas and it was okay. So they'd really
yeah,
thought it out, Like I said, it's a really great operator. So
yeah.
they were thinking it through pretty heavily.
Yes, yes. Now, yeah, I got it. I got it. Yeah, I can't think of there's one company there that does that. Yes, I know exactly what you're talking about. Yeah, they build it out and then already have someone dialed in to come in and take it over once they're finished with the footprint. Yeah, that's it.
Mhm.
Yep. So Scott, for yacht professionals or family offices with limited time, how does fund simplify decision making?
Well, the fund would simplify the decision making because you're not sourcing the property, you're not operating the property, and going into the fund, you have that diversification. You can look at multiple different asset classes, and
Mm,
and your appetite might change over time as to what you're looking at. You may want to be doing ground up development where you just want the long-term growth. You don't necessarily need the cash flow. You may
mm,
want, some of it in cash flowing multifamily apartments that are a value add projects that you're going to get a little equity bump at the end, or a bigger equity bump at the end, but you're also going to get cash flow throughout, those kind of things.
yeah. So for listeners, high income earners that may be listening to this podcast and they hear Scott talking, how does depreciation and cost segregation benefit investors, say, inside of a real estate fund?
You still get the 100% accelerated depreciation. Not with the development projects. Right away, you don't get that until the building is built or the land improvements have happened. But with like a value add project, you can get 100% accelerated depreciation. And I don't know the exact formula of what it works out to, depending on
Mhm.
what you put in and how the deal's structured. But that can be a long-term great wealth generation tool because over time you're getting that huge write-off, so you get to keep investing that money, and as long as you keep rolling it over, it can go snowball and it can be exponential.
Yeah. In addition to that, can you explain how passive losses from a fund can offset passive income, say for certain investors?
Well, for certain investors, you're talking about like real estate professionals. If you're a real
Okay.
estate professional and you qualify for that, you can offset that against all your other income, which that can be huge, especially if you maybe one of your spouses is a high earner that makes 250, 300,000 a year, and you're a real estate professional. Once you put that in there, then you can offset that loss with that 100% accelerated depreciation against against your wife's income or your spouse's income. But, again, I'm not a CPA or an attorney, so make sure you check with your professionals on this because it can be a great tool if you find the right CPA and attorney that can help you with structure all this stuff properly.
Yes, thank you for that because I definitely second that. This is for educational purposes only. Yes, always consult your legal and tax professional of any advice that you hear from any of my guests on this podcast. So, Scott, you focus on recession resilient markets. What does that mean in practical terms?
In practical terms, that's recession resilient areas.
Mm-hmm.
You see higher growth areas like Dallas, Fort Worth area, where
Okay.
you have a lot of corporate entities moving there. You have a lot of jobs moving there. You know, with population growing there at a high rate, if you see jobs moving there, people are going to move there. If you see corporations moving there, the corporate headquarters, jobs are going to come, people are going to come. And, a place like that, they all kind of go together. Like we look at Kansas City and the Midwest, a lot of those areas like that, because the Midwest is notoriously stable.
Yes.
It's a great place to live. You know, there's a lot of companies there. There's a lot of financial companies in those areas, and we look at a lot of those things, all those demographics. The lower crime areas, higher education, all those things we take into account.
Yeah. Okay. All right. Scott, you've lived a lifestyle that truly values time and freedom. How does passive investing support that philosophy?
It does, because when you're investing passively, especially as a professional, you put the money in, and granted, you've vetted everybody. That gives you back your time, because at a certain point you can keep investing and keep turning it over until you match your income, your job income, or a certain segment of it, and say, hey, maybe I want to work part-time, and you go, and then eventually you go, full time, and you can replace your job's income, and just you have to set those goals and everything, but it can really be very beneficial.
Yeah, awesome. Yeah, Scott, man, this has been great. And I know we could go on and on, but we both have things that we have to do. But
Most definitely.
yeah, but before I let you get up out of here, if listeners can remember one principle about investing from today's conversation, what should it be?
The one principle is, whatever you're investing with, partners or what have you, make sure you vet the people and do your research, get as much knowledge as you can, and apply it to what you're doing.
I love it. Well, Scott, it has been a blast having you as our guest today. And as we close out, please tell our listeners where we can learn more about you, get in touch with you, and learn about all the fabulous things you have going on right now.
Well, if you want to get a hold of me, it's pretty easy. Investwithscottkidd.com. I have my podcasts, all my social media links, email, everything. Please feel free to reach out. Love to talk to you. I love talking about yachts and real estate. So feel free to drop me a link.
All right. Awesome, Scott. Again, I want to thank you for your time today and all the wisdom you have provided to my listeners. It's greatly appreciated. And I want to thank you, our fans, for tuning into the service, the Syndication Real Estate Podcast, where we want to add value to you and your investing business. Please tune into our next episode, where we will interview another fantastic investing professional. See you next time.
Thanks for listening to the Service to Syndication Podcast. We want you to know that we love and appreciate your support, and we are grateful about being a part of your journey to becoming a successful real estate entrepreneur. Please share this episode with a friend who you think will get a lot out of what you just heard. Send it to someone who you know is interested in real estate and dreams of having it all and being the best they can be in all areas of life. And if this was really valuable, share it on your social media stories and timelines. Thank you for watching and listening. Now go be great.